We had a significant market event this week. Silicon Valley Bank failed and went insolvent within a matter of 48 hours this week, and the bank is now sitting in the hands of the FDIC. And the reason why this is a significant event is they're actually the 16th largest bank in the United States. In this video, I'm going to go over what caused the Silicon Valley Bank failure, whether we expect this to be an isolated incident contained just to that bank, or if there are contagion risks to the rest of the US banking system, how this could eventually affect Fed policy and interest rates, as well as the business fallout we'll most likely see over the next few weeks that is going to make headlines. I'll start out by giving you a little background on Silicon Valley Bank. So not a new bank by any means. The bank has been around for 40 years. And at the time of this failure this week, they had about $200 billion in total assets. So a sizable bank. But there is something unique about this bank. So this bank is known for its high concentration of lending to startup companies and venture capital firms. Because of this, Silicon Valley Bank has really become known as the go-to lender for startups and venture capital firms, which in itself just makes it seem like this bank is going to have more risk, which then could lead you to say this could very well end up being just an isolated incident. Because when you have a bank that has a high concentration of these high-risk companies, the risk of something happening is obviously greater. Now, other banks, of course, can lend to startups and VCs, but they may not have this high concentration like Silicon Valley Bank did. For anyone who's watching who doesn't know what a venture capital firm is or a VC, basically they're a big investment firm that takes in investments from individual clients, or they can take loans from banks, they pool the money together, and then they make investments in these startup companies. So they can take a loan from, let's say, Silicon Valley Bank for $10 million and then invest that $10 million in two startup companies. And the idea is if I take the loan with an interest rate of 5%, I'll hopefully get a higher rate of return by investing in these startup companies. That's the VC game. When we look at the startup side of the coin, the reason why lending money to startups as a bank is so risky is, unlike well-established companies that have been in business for many, many years and have predictable cash flows, a lot of these startup companies have not started producing net revenue yet. They're plowing all their money into what they expect to be something that's going to be widely adopted and make money in the future, but that's a bigger risk for these banks that are lending to these companies that have yet to produce real cash flow. The startup market has changed a lot over the last 24 months. When COVID hit in 2020, the government kind of opened the floodgates and put in these $1 trillion of stimulus, and there was a lot of money circulating the economy that could be used to fund a lot of these startups so they flourish. But then what happened is in 2022, inflation showed up, the Fed had to start doing monetary tightening, which is higher interest rates and pulling money out. So all of this capital that was essentially funding these startups was getting sucked out of the system, and it's still happening today, which is putting pressure on these startups' ability to make loan payments, to stay in business. And that's where a lot of the stress was being put on Silicon Valley banking and their clients. This could once again reinforce that this could just be an isolated incident with this bank that was lending to startups. Economy turned on them. A lot of their clients had problems. It might not spread to the rest of the banks. But now we're going to talk about the contagion risks associated with what's happened over the past few days that has surfaced that could impact the rest of the banking industry. The contagion risk that I'm about to speak about is starting to be acknowledged by the market, and we can see this by the fall in share price of other banks throughout the US, especially small regionals, for the last few days. So while Silicon Valley might have been concentrated in that startup sector, which might not translate over to the rest of the banks, there is something that's similar, and it has to do with the assets they were holding in their cash reserve that they were then forced to liquidate when these redemptions started coming in. When banks take in money from depositors, let's say they take in a few $100 million, one of the way banks make money is they take a good portion of those deposits coming in and they invest them in securities, like maybe treasuries, mortgage-backed securities, things that are considered safe investments so they can earn interest off of it while they're waiting for their clients to say, hey, I need that money back. And this is similar for all banks across the industry. The issue that surfaced for Silicon Valley Bank that then could translate to other banks across the industry is when the redemptions started rolling in and they didn't have enough cash on hand to satisfy those redemptions, they then had to turn to the securities portfolio and say, we're going to have to start selling these treasuries. But because interest rates have gone up so much, the value of those treasury bonds are actually underwater. So they then had to start realizing losses while they were trying to meet these redemptions at the same time. Herein lies the issue. If you buy a US Treasury bond, the value of that bond and the interest is backed by the full faith and taxing power of the US government. So it's looked at as safe. The problem is when you buy that bond, it has a maturity date. And if you hold that bond to maturity, the government says, we will hand you your money back. However, in between the time that bond is issued and when it matures, the price of that bond can fluctuate up and down. And one of the big things that impacts bonds is interest rates. One of the largest enemies of bond prices is rising interest rates. And it's no surprise to anyone that rates have gone up significantly over the last 12 months. So when interest rates go up, bond prices typically go down. And if you have these banks that bought these longer duration bonds before interest rates began to rise, let's say in 2017, 18, 19, when interest rates were still really low. So they were hoping to hold those bonds to maturity, but then all of a sudden the interest rates popped up and a lot of those bonds have now lost their value. And if all of a sudden they're forced to sell them, they then have to redeem them at a loss and they don't have enough cash on hand to meet all the redemptions. This is the exact situation that plagued Silicon Valley Bank when the redemptions started rolling in. They had to sell their fixed incomes at a big loss because interest rates had moved higher and they didn't have enough cash to meet the redemption requests. Going back to the potential contagion risk on this scenario, while other banks might not have this high concentration to startups or VCs, with everyone looking around saying if there's potential for a recession in the second half of this year and you start seeing auto loan defaults, mortgage defaults, line of credit defaults, and some of these other banks are forced into a similar position where now there's all these defaults they have to fill a hole for and redemptions coming in. Will they then have to take similar securities, start redeeming them at a loss, and run into similar redemption issues that we saw with SVB? This is the type of stress test that you might see banks go through in the coming weeks as investors say, not only the question of how well capitalized are you, but what are you holding as assets for your cash reserve if the redemption started rolling in if we see a recession later this year. And when we get that data, the results may very well be that there's no reason to panic. It might be that Silicon Valley Bank not only overextended themselves on risk to these startup companies, but also made a lot of mistakes just personally in that bank with the way they were handling their fixed income investments, which may not be true at other financial institutions. The market events this week could very well influence Fed policy going forward. We got a lot of hot inflation data in January and February, so the market was almost looking saying maybe the Fed does go 50 basis point hike in March, but this probably decreases the likelihood that that'll happen. Most likely we'll go 25 basis points now because they're realizing the stress that they're putting on the economy with these higher rates. There's some unforeseen consequences, like this issue with the pricing of treasuries at banks and redemptions coming in. There's things that we might not have seen before because we've never seen interest rates go this high this fast in a long period of time. So it might cause the Fed to be more cautious. Let's shift gears over to the FDIC insurance because it's been a while since we've seen a large bank go bankrupt like this. What does it mean for depositors and when do they get their money back? So FDIC insurance protects you up to $250,000 per person at a single banking institution. So similar to now, if this bank goes defunct, FDIC says, hey, if you had up to $250,000, you're good on that amount. For anyone or any company that had over $250,000 sitting at this bank, they have to just wait and see to see if they're going to get the money back, how much, and essentially when. They just don't know. And there's some pretty big clients. I mean, Roku, the publicly traded company Roku, came out on Friday and disclosed that, hey, we had about $480 million sitting on deposit at the bank when it essentially went defunct. So there's some big names out there. Besides just the individual clients getting their money back and companies getting their money back and how much and when, that's going to be one piece of the story. The other piece is going to be this business fallout. So when you look at startup companies, they need cash. Remember, they don't produce a lot of cash on their own to fund their own operations. So they depend on that cash that's sitting at that bank to fund their payroll, to fund their operations. If all of a sudden they've been cut off from that cash, they're now scrambling around to say, how do I meet payroll on Friday? And we don't have a lot of those answers. And unfortunately, some of the collateral damage from this issue is some of these startups might just not make it. They otherwise would have made it, but if they run out of cash, they just never see their dream to the end. So ultimately, does this end up becoming just an isolated incident or a contagion issue? We're going to wait to get kind of this stress test data that's probably going to come from these banks over the next few weeks. We want to see if the Fed is going to acknowledge this at the next meeting and potentially change some of the Fed policy to ease up on some of these rate hikes, to give these banks potentially some more breathing room. And again, how far in the distance is that potential recession? If we see one, the more time to it, the more banks might have time to get their house in order if they need to, if there are other banks at risk. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.